Do we have a new high? Not yet. Not yet. Maybe today. Hopefully soon, but not yet. Nifty is up 35 points. The breath, I think, is absolutely charged up. Wonderful market breath. And then let's look at some stocks now, which were occupying all the limelight. You want to start with Reliance, you want to start with the banks, you want to start with NBFCs. Reliance has to participate, which it has not. SBI has to participate, which it has not. iShares 28 rupees higher, Dr. Reddy higher, L&T higher, and then UPL also seems to be, moving in the right direction. So it's a good start, but all-time high, another 50 points more.
Almost there. We'll make it sooner than later. A couple of stocks, like Nikunj highlighted, the bull market is actually in the broader markets right now. So let's see what Titagarh Wagons, by the way, which is going to be called Titagarh RIL. We're going to be chatting as well with the management today shortly. Antique has initiated a buy, target price of 694. And it is these pockets, your railways, defense, that's where you're seeing the bull market actually take place. Manappuram Finance as well, a bit of a relief. The FIR against the promoter has been now quashed by the Kerala High Court. So that stock must be seeing some relief, holding up 2% as we speak. MOIL, which is now guiding over 20% volume CAGR over FY23 to 25. That's going to be another stock in focus. And then Skipper, which is bagged orders worth about 1135 crore rupees. That's another stock which is in focus. Hero MotoCorp, they've received a communication from MCA to submit information. That is acting as a bit of an overhang there. HAL, by the way, has turned out to be, or rather L&T has stand corrected here. L&T has stood to be the lowest bidder for the bullet train project, and this is a sizable one. 15,697 crore rupees is what we're talking about. L&T as well has been a rank outperformer year to date. HAL, the deal, it seems that between GE and the company will entail an 80% transfer of jet engine technology by value. And, most of the news reports seem to be indicating that a deal between HAL and GE is very much under place. So Hindustan Aeronautics will just come up here on your screens. ONGC, let's see what that stock is doing. Remember, crude continues to be buoyant, and it's hovering around those $76 per barrel levels on the Brent, and the windfall tax continues to be nil. So ONGC not really seeing much of a positive reaction, but the stock is mildly in the green. DRSL as well, there's been an EIR with a VAI status for the CTO3 Hyderabad API formulation unit. That stock is gapped up about almost 2% as we speak right now. And then, of course, RPG Life, they're looking at acquiring some of the brands to strengthen chronic as well as specialty presence of theirs. So these are a couple of stocks which are in focus. Look out for Havells as well. The shareholders have now raised concerns over the proposed remuneration to the CMD. So that stock is a little bit lukewarm in trade. What about the big buzzers from Friday? Let's see what HDFC Life, SBI Life, Bajaj Finance, etc. are doing, and whether or not that kind of momentum is sticking by within HDFC Life and SBI Life especially. Seems like headed in for a pause and some sort of consolidation, much like the index. Kunal, it seems like it's going to test our patience. I mean, we're optically almost there, but
yeah, I think it's
taking some time.
It should be just a matter of time, Aisha. I think maybe in the next hour or so, we should be hitting back the
That's
life
just one
heights.
trade from you, right?
So yeah, on the markets, it looks
You
very...
answer that question. You didn't answer that question.
Yeah, I chose not to answer.
Why?
No, so I think on the index, I think it's a good recovery for the index because many large cap names have started to participate. In fact, I was looking at the screen and HDFC Bank, HDFC Limited, Reliance Industries, SBI, many of these large cap names which were erstwhile a bit underperforming. I think these stocks have made a very good comeback for themselves. So I think that's one of the reasons why I would be more bullish on the index today. Reliance is a stock which I would look to trade in the open. That's a stock which I believe has already gained 3 or 4 days of consecutive mild price uptrend, but should see a more stronger follow through over the next couple of days.
Okay.
9 points away. 9 points away from an all-time high. 9 points away. Nuresh, 9 points away from an all-time high.
I think we should hit that today itself and maybe go towards 18,900 plus levels. So the view is positive. If we look at the broader indices, we've already hit another new all-time high, and this has continued for the last few sessions. So 10 points, maybe we have another 100, 200 points to go here.
To flag out a few more stocks before we move forward. 5-star, of course, the Nomura initiation is having a big impact on that counter. 5% higher for 5-star. Not just that, you also have Jindal Steel, wherein there has been an upgrade coming in from Kotak. So they have upgraded the stock to a buy and has made it a top pick from the entire metal space. So Jindal Stainless is the stock that should come up for you on the screen. 5% gain there. You also have Skipper, which is opened with a gain of 14%. Of course, that 1135 crore order is something which is doing well for the company. So 13% gain as far as Skipper is concerned. And then you have some other smaller names. Shriram Finance, of course, that large deal happened. So 5% trade there. Borosil Renewable is higher by around 7%. And on the losing side, you have PVR Inox, which is down about 2%. We were just talking about Adipurush, wherein the reactions from the masses haven't been that strong. So despite the fact that there's a 240 crore opening, it's not likely to change the fate of the all of these multiplex players, and that's why that stock is on the downtick. So cut of almost 2% coming in there, Aisha, for PVR.
Yeah, absolutely. Manishi Ray Chaudhary then joins in on the show. Manishi, hi, morning. We were hoping we'd be able to celebrate a fresh high on the index with you, but seems like it's going to test our patience a little bit more. But I think, what's remarkable, Manishi, is the kind of move that you've seen with the broader market and the underlying broader market, which already is in a charging bull market. Wanted to understand where are the spaces that you're finding comfort to even put fresh money to work at these levels there?
I think, the phenomenon that you're describing is basically the classic instance of investors' focus shifting from the top run stocks that had performed well earlier, because one doesn't really have the valuation comfort in the top rung frontline stocks. And that is why the investors' focus, the interest is gradually shifting down to the second and third tier names, even within a broad sector to different subsectors compared to what had performed earlier. And that is why we have the broader indices. Take BSE 500, for example. That is, they're trading at higher levels compared to many of the frontline narrower indices like the Sensex or the Nifty. I think this attempt on the part of investors to find cheaper names but which conform to the same themes are likely to continue for some more time, which means that maybe the mid caps and quality mid caps in particular, they would possibly outperform, at least in the near term. Another thing I would like to point out about the Indian market is that if you look at the broader indices, let's say Sensex or Nifty or MSCI India, the absolute valuations in terms of price earnings or price to book are not really that expensive compared to the long-term history. So today we have, let's say, MSCI India trading at a little more than 20 times 1 year forward PE. The long-term average is somewhere around 19 times. I think about 18.78 or so. So it's about 7 to 8% premium. But where the investors, particularly the foreign investors, don't exactly have too much comfort is the relative valuation. Because on a relative basis, there are many markets in Asia, particularly in North Asia, which are trading at far cheaper valuations. And therefore, finding stocks which kind of conform to the same theme across Asia, but at the same time, which are cheaper, is turning out to be easier in those markets. India has benefited massively from FII flow reallocation. It has happened away from China and into India in the months of May and till now in June as well. But on a relative basis, India might take a bit of a breather in the near term purely because of this relative valuation premium.
So is it time now to upgrade your Sensex year-end target, which stood at 66,000? And when are we likely to hit that 1 lakh number on Sensex? Likely to happen in the next 2 to 3 years, you believe?
It's a kind of a sentiment boosting number. But think about it this way: India's nominal GDP growth is somewhere in the range of maybe 10 to 12%. Real GDP about 7%, and let's take about 4% long-term inflation rate. That's about 11%. That's nominal GDP growth. Usually, corporate revenue growth, earnings growth are slightly higher than that. Let's take anywhere between 13 to 14%. Therefore, if the market grows, if supposing valuations remain at the same level, and therefore the broader market kind of grows at this level, it compounds at a rate of 13 to 14%, we would automatically be at that 100,000 level, in about 5 to 6 years, possibly. I'm just trying to do the mental arithmetic here, but if you have an Excel file in front of you, that's a lot easier. So it's not rocket science. So just going by the present rate of growth, that magic number of 100,000, which has been talked about extensively, it would obviously be achieved. But the real issue here is how investors make money and how they make money at a faster rate. How do they outperform the broader indices? And for that, I think there would be no alternative to the age-old methods of looking at stocks carefully, looking at the themes or sectors that would outperform some others.
We are still negative on a YTD basis in terms of flows. And if I add to that the outflows which happened in 2022, even for FIs to come back to their 2021 levels or 2022 levels, they will have to come in with at least $6-7 billion more. Do you see that level coming back?
Eventually, yes, not in the next 2 to 3 months. And I'll tell you why. Because we're again entering a period where the US dollar, at least on a short-term basis, would possibly appreciate, not only because the narrative about the Fed rate keeps on changing. Earlier, even a month earlier, we thought that the May hike was the last one, but now we think there would be one more hike in July. And what happens beyond that is it remains data dependent. It depends on how the employment scenario, the non-farm payrolls in the United States would pan out, how core inflation, particularly core inflation excluding shelter, and that's a key variable that the Fed looks at, how that pans out. Second, we are also in the midst of QT, quantitative tightening, which would possibly take out another few $1 billion. It's currently at about $95 billion per month. And till about, let's say, September or so, all throughout the summer, this would continue to constrain liquidity in the developed market. And the developed markets are where bulk of the Asian emerging markets get their flows from. So we have to be mindful about these two factors, the currency and allied to it, the constraints to dollar liquidity that might hit us in the near term. Eventually, I think emerging markets, particularly India, within the emerging markets, the foreign institutional investors don't really have an alternative to that. It is one of the highest growth markets. It's one of the economies that's possibly the most stable for now. And, all the the bells and whistles, the usual economic drivers, they all have the necessary tailwinds, at least over the foreseeable time horizon.
We don't have you on the best of the connection, so we'll let you go. Thank you so much for joining us today and talking to us about your market outlook and that magic number of 100,000 on the Sensex. But let's talk about some more fundamental opinion and the sectors that you need to watch out for. While financials will retain the leadership for the next few years, sectors like defense, capital goods and infrastructure could steal the spotlight for the next 2 years. That's the word coming in from Manish Chokhani of the Enam Group.
Look at people outside, they're very enamored by the Indian consumer. So you'll find all the consumption stocks, the discretionary stocks are all pricing in 10 years of growth. I think the pricing is wrong there. The thesis is correct. Eventually we'll have a J curve. But before we get there, we need to lift that per capita income up, which we are stuck at whatever, $2,500 or whatever number. But before that is to happen, a lot of the jobs in manufacturing, the jobs in infrastructure, the build out of India has to occur. So if you were to kind of phase it, The next couple of years is really the period of infrastructure, capital goods, and defense, railways. All these companies are really going to benefit a lot. And I don't yet think the prices have captured that fully. As you continue, again, our old theme, the financials, are at the center of everything. So while the last few years they've all gone after the retail guys, I think this whole corporate banking, the PSU banking pack, if you take the top 3 or 4 banks after SBI, they're all in 30,000 crore type PPOPs, looking evident, which are large numbers. SBI will be north of maybe 1,25,000 crores. I don't know. I think you just interviewed the chairman. The numbers are going to be staggering coming in. HDFC itself will be probably close to a 1 lakh crore PPOP. So the numbers that will start coming out are going to startle people and shock them. And therefore, things which have kind of underperformed, think, oh, everyone owns banks and financials are over-owned, overexposed. I think over the next 4-5 years, the leadership of this market will be very, very strongly with this entire group.
So if I say that banks is a consensus buy in terms of a view,
Sure.
but it has not reached consensus pricing, will I be correct?
I think, see, look at it this way. Everyone knew 10 years ago that Amazon, Apple, Microsoft are spectacular. And yet the biggest wealth creation came there because the percentage churn
Great point.
on large numbers, the delta that you make on the wealth is, sometimes you miss the point on just looking for percentage gains. But on a large position, if it then multiplies from there, the absolute impact on your portfolio is very, very large. So today, it's become very popular that, oh, you must keep churning and moving, or it's a technical trade that HDFC Bank will see selling pressure and so on, let me get out.
All right, now let's connect with the management of Bajaj Auto, Mr. Rakesh Sharma, to understand that what would be the impact of changes in the currency for Nigeria, impact of demon and fuel price hike. Because Nigeria is an important market. Normally with Bajaj Auto, we first understand what's happening to EV in India, but today we want to start and discuss Nigeria. How important is Nigeria for you? Can you just share that number with our viewers, and then we'll get into specifics after that.
Good morning. Yes, Nigeria is our single largest overseas market. As you know, about 50% of Bajaj Auto is exported, and about 25% of that is Nigeria. So, it is a significant value. But of course, we do the entry-level Boxer 100cc bikes mostly there. And we have a very good position over there, which is, almost as 55 to 60% market share. So all things considered, it is indeed a very, very important market for us.
We'll break the simple maths here. 50% of your business is exports. Within that, Nigeria is about 50%, which means more than 12%. 25%.
Yeah.
Okay. So that means that's a sizable number. I mean, that's a sizable number, almost like a double-digit revenue which you get from Nigeria.
Yeah, about 12 to 15%.
Okay.
Volume, basis volumes, not revenue.
Of course. Volume is what you get from there, and even entry level. Thank you for that very simple, data. Now let's understand the dynamics there. There was a demonetization which was at play, and there is a currency devaluation which has happened. Currency devaluation for an exporter is always great news because you get benefits. So has the Nigerian market which has suffered, or the Nigerian economy which has suffered because of a variety of factors, are you seeing that things are going to improve incrementally for you?
Yes, I think things are going to improve. The situation was quite severe in the last few months in the run-up to the elections, which happened, I think, in March, April. And there was an accompanying demonetization. There was a bit of a paralysis on the policy front at that period, and which encouraged the parallel markets, etc. The transition of power to the new government has been largely peaceful. There have been sporadic incidents. And, I see these signs as the new government, and particularly the central bank, taking control and, putting out policy directives, which is actually very welcome, because there were two exchange rates operating. One was the so-called official one, and then the largely used parallel one to source the dollars. Now with their central bank stepping in, you can see that the effort is to converge the two and just have one. So from a longer term perspective, this is a very, very welcome news if a large market like this starts to get reorganized. This was the case a few years back, then it drifted, and now there is an attempt to reorganize. At the same time, there is a recognition of subsidies which are going for fuel. Those have been removed. Again, this has caused an increase in petroleum product prices, which is also in the short term going to impact the purchasing power and lead to inflationary issues. But again, it's a recognition of the reality, which is all very good, because we are in it over there for the longer term. We are not looking at it month to month.
So, Mr. Sharma, let's assume that things go back to normal in your Nigerian market for Bajaj Auto. So incrementally, what changes? Incrementally, what changes for top line? Incrementally, what changes for bottom line?
Well, see, we used to do about 50,000 units per month. Some, season months, we would do about 60,000 motorcycles per month in Nigeria. In the period of Jan, Feb, March, it even dropped down to something like 4,000 units. And now it is touching almost 30,000 units, so there is a recovery underway. So you can see if this normalcy, and we have to also see how long the consumer will take to digest these things. I think everybody is echoing the fact that things are being systemized, but there will be a short-term pain. Now, how long the short-term is, one has to see. But already the recovery is on its way, and hopefully the availability of US dollars will improve for organized businesses like ours, and that should lead to further improvement in exports from here, because our stocks over there are pretty thin now.
So, Mr. Sharma, net, exports have been one space which has been disappointing the street for Bajaj Auto. When do you see the recovery happening and, let's say, back to the normal levels?
Well, I've been saying that it's going to probably take a quarter, but I cannot give you any specific date of recovery, because there is no specific one event which we are waiting for. If you understand the root cause of why this decline in overseas markets is there, then you will understand that the recovery is also not a 0-1 thing. It's going to be gradual. It has been largely caused by a cautious stand by the central banks of various emerging markets, because they've taken a very cautious approach because of the strengthening of the US dollars and the lack of availability of US dollars. So they've tended to prioritize the more important imports like drugs and pharmaceuticals, and in some cases food, leaving much less for categories like automotive. And that is at the nub of the problem, which started quite suddenly and sharply in May, June of last year. Since then, you know that the US dollar has continued to be very strong. It's only recently that we are now getting some news of its softening. We have to see how the central banks respond to it. We have seen some kind of a loosening, but very, very marginal. And if this kind of trend continues and there is no other black swan event, then I suppose we will continue to see some recovery in about a quarter's time, or within the, let's say, within the Q2 of our financial year.
Tell me, your Pulsar was launched in Mali, as we understand, earlier this month. How's the response there? And then what's the buzz around the Triumph bike launch in London that's going to happen later this month?
Sorry, I didn't catch your first part of your question. The audio wasn't good.
Sure. No, I wanted to understand, how's the response been to Pulsar, the launch in Mali, as I understand?
Mali is a very, very tiny market. It constitutes in decimal points in our portfolio. And I'm very impressed that you are tracking Mali for us. We'll have to wait and see how it goes. But it's not really a mainstream product over there. The mainstream products continue to be the taxis, which are the 100, 125cc, 150cc boxers over there. So Pulsar introduction is just catering to a very, very thin sliver of personal use segment.
So Sharma, why is that Bajaj Auto is not able to develop any new big export destinations like Nigeria, Sri Lanka? These were destinations which I used to track 10, 12 years ago. I have not heard you developing a new market, which in a sense is a market where the two-wheelers could be accepted, looking that you're globally competitive.
I would be delighted to get some ideas from you. We are in 96 countries, and we started with the list of 164 countries, which is the United Nations list, give or take a few, and we are in 96 of them. So, I really don't know where to look at the map. For our portfolio of products, we are in every single market, which is over 7,000 units per annum.
Can I change gears and come back to India and understand what's happening in the EV landscape? Because now we understand that the booster which was given to the entire EV industry in terms of tax advantage, in terms of duty advantage, that is going, and the current EV two-wheeler companies are saying that if you take it away, we will go away. What is happening, sir, in the EV two-wheeler market?
Well, you're right. There has been an abrupt reduction of subsidies under the FAME scheme, which have almost broadly been halved, and therefore the prices have gone up by that kind of an amount for the consumer. And this will, of course, again, in the short term, have a salutary effect on the customers coming into the purchase cycle. I think they will sort of go back and do the maths and see whether it still makes sense. And I still feel at this point also, it does make economic sense. A lot of the people, most of the purchase which was happening because of economic reasons and a little bit because of convenience, but almost nothing for environmental reasons. So the maths is still in favor of electric scooters compared to i-scooters, depending on the kind of daily run which you have. The more the daily run, the better the return is. So I think the consumer will come back to the buying cycle. Of course, the capital cost, the acquisition cost for the customer has increased. So it will shrink the pool a little bit. But that kind of shrinkage will probably hit some of the weaker players far more. And this move will, in fact, accelerate the consolidation of the industry. A couple of years back, or 3 years, till 3 years back, there was a lot of companies which were just importing components, slapping them together and putting them out in the market. There were almost 30, 40 companies. Now you can see that almost 80% of 65% of the business is with the top 4, 5 companies. And hopefully this consolidation will continue to roll. And that's good for these companies which are left. And it's good for the customer because that customers will get solid, stable, and reassuring propositions.
All right, Mr. Sharma, really appreciate your time and so glad you could join us.
Thank you.
Umesh Revankar joins us, Executive Vice Chairman with Shriram Finance. Mr. Revankar, good morning. Thank you for joining us. There's a block deal in Shriram Finance today. We understand that it is TPG. Could you confirm it to us that it is TPG, and after this deal, how much TPG stake is still left in the company?
To my best of my understanding, I think it is a total sale. Nothing is left in Shriram Finance Limited. But TPG has been our partner for more than 15 years. And they continue to be our partner in insurance venture. So they have been our strategic partner, well-wisher, and we continue to work together.
But is TPG exiting largely? This is because, look, they were an investor and now as an investor, they want to perhaps lock their gains, or perhaps the LPs are asking for money back. Is there a reason why TPG is exiting? Because the long-term picture for Shriram Transport Finance is so strong, and when the credit cycle has just about picked up for the entire CV business, why would a long-term investor sell? Because अच्छे दिन तो आ रहे हैं.
Yes, see, it is a good opportunity for the company, especially NBFC and Shriram Finance to grow, and the market is good. The asset quality has been improving all time, and everything is very positive. But as you rightly put it, the TP has been with us for quite a long time, and they have every scheme or every fund has a limitation. And I think this particular fund, they have been, I think, with us for more than 7 or 8 years, and they have to sometime retire the fund. So, and that's the reason. So, however, we are quite happy with the TPG, and definitely we expect them to partner with us in our future ventures.
Shankar, could you tell us who are the buyers of this 2.65% stake if you have some details?
No, I don't have confirmed breakup, but many of the Indian mutual fund have participated, and there are also some FII participated.
Existing ones from the list of stakeholders, or are there newer names as well?
It looks like most of them are new, and some of them are existing.
Interesting. So that's good to know. But let's talk about business now, since we have discussed the details of the block deal that happened. You had guided for an AUM growth of around 15%, which you expect to sustain. Are you looking at increasing that number? Because as we were just discussing, there's a lot of tailwinds for the credit to actually keep on improving.
Yeah. See, if you look at the overall business scenario, especially in the main business, that is the large business which we are in commercial vehicle, year on year, the sales are improving, including the heavy commercial vehicle sales are improving. That indicates that market is able to absorb the new vehicles in spite of increase in cost of acquisition. So that is very positive, and there is very good demand for credit in the SME segment also. And since we are now expanding the SME segment across the country, we do see a good opportunity to grow our business. And definitely we will be able to maintain that 15% guidance which we are given on the AUM. But what we would like to focus is to grow the bottom line much better than the top line. So that is the idea behind the merger synergy and the advantage, strategic advantage what we have. And we are very confident of delivering it.
You've also talked about demand for used vehicles, wherein you see strongest of the growth coming in terms of your AUM accretion as well. Tell us what more gives you this kind of confidence. I mean, is the used vehicle market really growing?
Yeah, see, one thing is used vehicle market is all dependent on how the economy is growing. If the economy is growing fast, then it needs more wheels to be added. Now, this can be added through the new vehicle sales or used vehicle transaction, and it's a combination. So it is not that just used vehicle demand comes, but what happens is the urban, rural market and semi-urban market, you normally see the demand for used vehicle because the capital expenditure for acquiring used vehicle is less. And since it depends upon their application and distance to be traveled, people prefer used vehicle in those areas. But in urban or in the infrastructure, in the mining, all these areas, you will see demand for the new vehicles. So it depends mostly on the application and also from the segment and geography from where the demand comes from.
Mr. Revankar, a little short on time, so quickly a last word. You had indicated that Q1 margins will be slightly under pressure. What could be that pressure?
I don't see any pressure on the margin. In the past, we did mention that if the interest cost is increasing, then there could be some pressure. But now, since last two RBI announcement of no repo rate change, I think it is slowly softening, and we should be able to maintain our net interest margin at the current level. And we are hopeful that it will continue to remain for a long time.
Sure, Mr. Revankar. On that note, we'll let you go. Thank you so much for joining us. We'll actually slip into a very short break with the news that the market is a little more away from the live high levels, almost 50 points to catch up.
Kumar Sabaya, CFO of CEAT, joins us now. Kumar, good morning. Thank you for joining us. Let's first understand the sector per se. A lot of tailwinds have come back, whether it is on the demand side, also on the raw material side, and also in terms of where the replacement market is moving. Do you see that next 6 to 12 months for the tire industry per se could be strikingly different from the last 6 to 12 months?
On the commodity side or raw material cost side, there has been some stability in the prices, unlike the previous 8 quarters. So the material prices have been moving within a range. Okay, crude, for example, has been moving within a range of $75 plus or minus $5. And natural rubber for last 1.5 months has been moving within a range. Though prior to that, the local rubber prices moved up. So on the margin side, where the raw material plays a role, okay, should the commodity prices remain within a range, okay, we expect there's some kind of stability in the margins. As far as the revenue side, normally in summer months in the local market, we tend to sell more as the demand is higher. Exports is slowly recovering, though it's not gone back to where it was, say, prior to Russia-Ukraine war. And as far as OEM demand is concerned, the demand has been good from commercial category, but in case of two-wheelers and some other categories, the demand has been, I would say, stable. That's the way I would like to sum it up.
So stable demand is what you're pointing out, at least nothing incrementally negative. But talk to us about your market share targets as well, both for the two-wheeler segment as well as passenger vehicle. You have quite ambitious target for market share gain. How do you expect to kind of scale up? Are you looking at new launches? Are you looking at deepening the presence? What's the strategy?
Okay, and see, for us, passenger is core. Okay, passenger categories of tires, basically passenger car and two-wheeler categories are core to our strategy. So from that point of view, as far as two-wheelers concerned, and in the replacement market, we expect our market share currently to be in the range of around 27-28%. We would like it to inch up closer to about 30%. That's our short-term and medium-term plan. As far as passenger car category tires are concerned, currently we are closer to about 15% kind of a market share in the replacement market. Okay, and we would like to take it up to around closer to about 18% in the 2 to 3 year kind of a time frame. And we have built adequate capacities to meet the requirements, and we are working in terms of developing new products. Entries into various OEMs is also one of the levers that would help in getting some growth in the replacement market. And we continue to be present in growing categories like EVs, where we are making efforts to ensure that we gain some reasonable share. So those are some of the steps that we're taking.
Mr. Subbiah, I also wanted to understand, when it comes to exports, what's your strategy? Because there as well, you're sounding pretty optimistic and bullish, and you're looking to double your revenues by FY26. What's instilling this kind of confidence? And more importantly, are you looking at further investments? Are you looking at exploring some M&A opportunities?
Last 2 to 3 years, we have been growing strongly in exports. Okay, and in the overall, our revenue share, exports used to be around 12 to 13%. Okay, in the FY22, we reached a level of about 20%. Okay, and FY23 was relatively a weak year for exports, and therefore our revenue share was more or less in line with the previous year, about 19% or so. In terms of your question with respect to what are our strategic actions, one is that our specialty tires, which is agri-radial tires, where we build capacities and we would like to grow strongly. And we have been growing strongly on a small base. Second, we launched our truck and bus radial tires in Europe market last year, July, which we would like to scale up. And our passenger car exports to Europe and other parts of the world has been progressing well in line with our plan. And towards later part of this year, towards the end of the current financial year, we also intend to enter US market for both truck and bus radial and passenger car radial tires. So these are the levers that we expect our revenue share to go up from current level to closer to about 24-25% over a 2 to 3 year period.
Okay. How much demand do you see is coming back from the pure replacement market?
No, replacement market demand is a function of what is happening in the economy. Okay, and different categories of tires have different demand factors. So, in case of commercial categories of tires, we are seeing some good growth, good demand for the last 6 months or so. Commercial categories faced issues in the previous 2 years; they were not able to grow. In case of passenger car, we are seeing growth. In case of two-wheelers, the market is still kind of flat. Okay, so that's the way I would like to split the replacement market demand. So to just sum it up, commercial category is growing well. Passenger car is also growing. And in case of two-wheelers, it's kind of a stable.
Just before we let you go, I know you gave a bit of color on the margins already, that the raw material pricing is stabilizing, but help us understand a few more details. The analysts are penciling in a number of almost 13% when it comes to margins or FY24, and that compares with around 9 to 10% which FY23 clocked in. Do you think that's a realistic number, 13-14% for FY24?
It's difficult. We normally don't guide, okay, but however, we can give you some indicators. And in the Q4, we closed the Q4 closer to about 12.8% kind of margins. On an overall full year basis, our margin was about 8.8%. Okay, and generally we are comfortable in a two-digit kind of margins. If raw material prices remain within the same range, and if you are able to hold on to our final product prices, okay, and we would be in that range, comfortable range of about 11-12%. As far as Q1 is concerned, generally our marketing cost is a little higher because we spend more money during IPL. So that needs to be factored in as far as Q1 is concerned. Otherwise, I think we are in a comfortable range. It's difficult to forecast what will happen to commodity prices as it influences the margins. So therefore, we are in a comfortable range. I'm not able to tell you we would be at 13% or at 12%. We would like to wait and watch.
Sure. Since you did mention IPL, would it be fair to assume that the marketing and ad spends will only be higher as the year progresses?
No, in Q1, obviously, we are more active with respect to IPL, and therefore we spend more money. And our advertisement cost also, the amount of money that we allocate also depends on how the business is doing, our normal margins that we get, what happens to our costs and things like that. When we want to focus on passenger category, it is important that we spend adequate money on sales and marketing. So therefore, we expect our advertisement or our marketing cost to be higher this year, both in absolute terms and also as a percentage of turnover compared to the last year, if you are able to maintain the Q4 level kind of margins.
All right. Really appreciate your time, and thank you for joining us with your update. I'm just going to shift focus and then see where are the markets, and just 10 points and we would have otherwise made a new high on the Nifty. Bank of Baroda, HDFC Bank, they're doing okay. Patanjali ahead of the roadshow is looking charged up. You got price action which is quite constructive in IDFC Bank today, and then good old NBFC stocks, whether it's 5-star, M&M Finance, Bajaj Finance, L&T Finance, all of them are looking very charged up. Mr. Y. Sikri, Managing Director of RPG Life Sciences, joins us now. Well, we've got the range of RPG Goenka Group companies on channel today because all of them had Analyst Day. So we're going to shift from CEAT, which is the tire company, to RPG Life Sciences. Mr. Sikri, good morning. Thank you for joining us. Walk us through, sir, first the big picture. For those who want to understand that what is in store for FY24 from RPG Life Sciences, what they should expect, what curve of the business cycle you are in, and how will this year be different from last year?
Morning, Nikunj, and thank you so much for getting me on the show. And if you allow me, I think before I answer your questions, a little bit of the background is important, if you allow that, so that people get the perspective of this year as well as the next year. The RPG Life Sciences is around 55-year-old company. It is a unique history. It was earlier SEARL India Limited, which was a joint venture between RPG and SEARL. Towards the late 90s, SEARL exited the country and the company became as RPG Life Sciences. Now, this background has some unique points in favor of, or maybe some negatives of RPG Life Sciences. So one is company of this size would have never had representation in all the three segments, which is domestic formulations, international formulations, and API, but this company has. Number two, we have plants. We have plants of API, we have plants of formulation. Ankleshwar is formulation plant, and API we have in Navi Mumbai. Being the company for 55 years old blesses us with systems and processes, experienced people, and a certain kind of loyal customers, which we have in our fold. Very important, very important point is we got certain very great brands, which we call as textbook brands in our fold. And lastly, the strong RPG parentage. So what we have tried to do in our strategy, we have tried to see that we maximize on all of these things. So with 67% of our business coming from domestic formulation, 18% coming from international formulation, 15% coming from the API formulation, obviously we decided to focus on the domestic formulation, which makes about 2/3 of our business. And that's what we have done in the last 4 or 5 years. And consistently, we have grown faster than the market, and considering all the issues and opportunities, we figured out some 5 pillars for our growth in domestic formulations. And those 5 pillars are little important for viewers to understand, so that answers the question going forward, what our strategy is going to be. The first thing was, being an old company, we were loaded with old portfolio, so we had to rejuvenate our product portfolio. Number 2, we had great brands, so we had to make sure those brands have brand equity, but those brands have to become big brands or mega brands, which you call a strategic asset. And the third one was productivity. We had to work on our productivity, and the last one was, if you're working on productivity, our customer coverage must be to the tune of 85 to 90%. And the last one was the profitability improvement or cost reduction. So first one, product portfolio rejuvenation. We have identified close to over 40 products. We have a 3-year new product grid in place. Accordingly, we are launching the products. Today, the new products are contributing about 28% to the domestic formulation sales. Productivity, we have moved from...
I have a simple question, sir. In last 5 years, your profit has gone from 11 crores to 50 crores. Will this kind of a trajectory continue?
Yeah. So if you look at last 5 years, consistently there has been an improvement. Basis how it has happened, it's basically because of the structural issues which we address. So expect the profitability to continue because of the structural areas which we address. If you allow me, it is basically the organization structure optimization, formulation re-engineering, looking at each process so that those processes are cost efficient. All of that has helped us to improve the profitability, and I expect that to continue.
So let's put this into numbers, because your domestic business, as we understand, Mr. Sikri, has grown by 20% versus IPM growth of 8%. What is the scalability headroom, say, in the next 1 to 2 years?
I think it's an important question. The reasons why the growth has been higher than the market, those reasons continue, which I just mentioned. The series of new product launches which we have planned out will continue. The life cycle management for existing products will continue. Just give you one illustrative example. We had a brand called Neprosin, which is a textbook product, which is a pain reliever brand. We were around 18 crore in FY19. Today we are at 62 crore. And that's thanks to the life cycle management strategy. This is just one illustrative example, just to assure that how the scaling up will continue going forward. Second, scale up will come from inorganic opportunities. Today, we are a debt-ridden company. Minus 15 crore was the debt in FY19. Today, we are a cash surplus company with around 115 crore cash available to us. So we have now emboldened ourselves to be finding out the M&A opportunities for us. And I should share with you that we have last 1.5 years, we have evaluated close to about 18 opportunities. We have submitted bids for about 2 opportunities, and we are active in that space. And hopefully we should be able to have some deal going forward. It fits into our criteria set. Second is we are also looking at the adjacencies in the medicine space. So we have a strong repo in certain class of customers like nephrologists. So we would like to have, we like to maximize or optimize our relationship with them by offering some other product offering which they are interested in and they will prescribe. So there's another way to look at domestic formulation business growth. And the third one is new therapy. We are entering into new therapies. We were only in general medicine business. We are only in nephro. Today, I'm pleased to share with you that we have representation rheumatology, we have representation dermatology, and on the mass business side, we have representation on the cardiology, diabetology, and urology. This also gives us a better profit margin because chronic is better placed than acute on the profit margin. So these are the few points which I can indicate with respect to domestic formulations.
Great to hear that, Mr. Sikri, and so glad that you could take time out and join in today.
Thank you.
Thank you so much. Okay, that's the word coming in from the management of RPG Life Sciences. For the market, it's turning out to be a bit of a disappointment this Monday morning, just when we were gearing up for that all-time high that it eludes us. So we've fallen actually from the day's peak, or rather the opening peak, but we're still holding on to 18,800 for now. Quick break. When we come back, chart checks with Kunal as well as Naresh.